So the next panel, I'm going to moderate. My name is Ronen Kirsh again. It's a VC and hedge fund panel, and I'll let each individual to introduce himself.
Hey everyone, I'm Spencer Bogart with Blockchain Capital. We're one of the oldest venture firms dedicated to investing exclusively in the blockchain and crypto ecosystem. Our firm's been around for about 6 years now.
Hi, my name is Jonathan Allen. I was an explosive ordnance disposal technician, disarmed bombs for 5 years, then pivoted into blockchain. Really kind of made sense, good transition. Helped co-found blockchain at Berkeley. Now I'm mainly focused on Dekrypt Capital, also Dekrypt kind of token services and building that kind of ecosystem to advance the blockchain space.
My name is Joey Krug. I'm co-chief investment officer at Pantera Capital, where we have a suite of funds that are investing in the blockchain space.
Hello, everyone. So I'm Debbie Wen from DHVC, like Dekrypt Capital, and so we are running a $500 million fund here, investing in like anything blockchain, crypto, and so what's very interesting about us is we have investor like half of our capital coming from Alibaba, Tencent, Lenovo, and a lot of like major Chinese internet firm, and we have and the other LP are Renaissance, like First Manhattan, so they're like Wall Street people. So it's a pretty good combination. So both from US and like China.
Thank you. So I think the first panel and the second panel pretty much cover all the topics that we want to talk about. But I mean, let's maybe kind of address a few of those topics. So there's a lot of ethics arguments that brought up what is right, what is wrong from a VC, pre-sale, etc. It's very obvious that VCs are getting some type of discounts. Whether they're dumping the market or not, this is really, something that it's not publicly. Maybe you guys can address that. I believe our audience want to get your opinion on it. What do you think about it, etc.
Yeah, I mean, I think everybody kind of realizes that this is a problem. It is kind of the nature of the beast when something is kind of the Wild West and it's kind of maturing. I do think that, some of the things mentioned like SAFT or these lockups are something that's going to be kind of changing. If you have these VCs who are kind of investing in these things early stage before the utility is really built or it is just a white paper, it would make sense for them to kind of get this like small discount, because they are taking that risk. But you really have to kind of pair that with a lockup. You're seeing a lot of these ICOs that are kind of having some equity portion or some token sale or, these like 1 to 2 year lockups. And then that really kind of brings back this alignment of kind of incentives, where if you're actually advising these things and investing, you should be doing it for the long term because you believe in this company, not because you're looking to kind of flip those token sales. And that's really what we see going on, and I think it's really healthy, and I'm hoping that continues.
Yeah, I'd also like to just correct a few things that I heard earlier. The first is that VCs just make free money out there, and it's just we're sitting around and collecting cash from the sky. Blockchain Capital's been around for about 6 years, and it hasn't been profitable until probably 12 or 18 months ago. And we continued evangelizing and taking a lot of risk on this industry when nobody cared. And honestly, when we were laughed off a stage, and when we were laughed out of Wall Street, and really it's great to finally see things working out in the industry. The second thing is that venture firms make returns off of discounts. First of all, we're not even interested in things like, well, I heard things about like 1,000 and 10,000% discounts. I'm not getting those deals, so if you are, please let me know. But usually what we see is things like 30% discounts, and to be honest, if you're a venture firm, you don't get economics that way. You're not there as a venture firm to make 30% returns. That's something that might be attractive to a hedge fund, but your LPs are not going to be happy if you return 30% of your capital after you lock them up for 8 years. And then I had another point, but I'll pass it along.
Yeah, I would say, another thing is like the discounts, they're really actually like, there's two kind of reasons why they existed. One reason is a bad reason and they shouldn't exist for this reason, and the other reason is a good one. So the good one is they're originally designed as an incentive for, entities to fund these projects early on, seriously help them build out their project until they're ready to actually do a regular sale. The other reason is they do a discount and they raise a bunch of money 3 weeks before the public crowd sale. The second one of those is just like pretty much useless and not like an actual useful thing for anyone in the market. Another reason it's not useful is if you look at the market, those sales that have done that, basically if everyone gets a discount before the sale, then the discount is meaningless. And so I think if as the market will cool off a bit, I think it will switch back to the way things were before, which is you'd get a reasonable discount for helping one of these projects along, working with them, dozens and dozens of hours as you help them kind of design their protocol and help them with any sort of technical or business issues they face.
Yeah, and so one thing I want to add here is, we have seen a lot of founders, so they just apply the discount for the sake of valuation. Because one relevant question here is how you value the token, and because if the token valuation is probably market cap about probably 10, 12 million, and then so they might give a discount saying, oh, so I give you 50% discount, and then so for a total market cap of 20 million, and so essentially you're actually getting the same thing, but it's inflated. So it's inflated discount and a pseudo discount, I would say. So I think as an investor, I will actually watch out for that. And the other thing is, so as a entrepreneur, you have to really watch out for any potential concentration of investment concentration. If one potential investor, so they're getting 50% discount and then taking 20% of your total token, and then so that can be a big problem. And so you will also have to watch out for any of the flipper and just dump it around.
And just to add one more thing on there is overall, again, if you go back to the venture model, again, these 30% discounts and things, they don't make your money, and they're bad for overall the company. So when we look at a project and we're saying, okay, you're going to sell to a bunch of people at a 30% discount and then try to sell to everyone else at a 30% higher price, that doesn't feel like a way to build a good community. And so it's not something we really like to see. Instead, we'd much prefer to see a valuation cap, the same way when you invest in a seed or a Series A round, you typically cap the valuation of the company at something that's very reasonable, that's commensurate with the risk involved with the project. When you're just a team with a white paper and you're hoping to build a project, there is an incredible amount of risk involved. And so we typically expect to see valuation ranges. A typical seed or seed stage valuation might be anywhere from a 2 million up to, at an extreme high end of just a phenomenal team, all-star, tackling the biggest problem in the world, maybe a 20 million if they have part of their product already built. And that's really the way that you ultimately make venture returns long term. And then also the last thing is just that, from our perspective, tokens aren't even that attractive. We'd much rather own equity in a company for the simple fact that equity tracks founders a lot better. So, how many tech companies out there are successful today, but only because they're on their third or fourth pivot, right? And if you make a token bet on the very first product iteration, you might have the right team and the right idea tackling the right problem, but they might not be right in their first iteration. If you own equity in the company and they do a second token launch later, or they change the product, or they pivot to a different model, you make sure that you have exposure to that either way. And so it's about downside protection when there's a lot of risk involved.
Yeah, and maybe to continue on what you just said, the strategy of your investment, how do you hold teams accountable with those ICOs, for example?
Yeah, so I think the way we really look at things is we look for places where we can really be a value add, places where we really kind of believe in the team, and we want to be kind of deeply integrated with this. I think it's kind of interesting. You have the venture capital, you have the hedge funds, but really in this space, there is kind of this blend, there's this overlap. It's not really clear where that delineation is, because a lot of these teams, there's so much money flooding into the space, aren't really looking for that dumb money. They're looking for someone who's a value add, who can kind of guide them through this process. There's so many different facets of the ICO process and kind of building out a blockchain project that they really need the help and kind of diverse things. So that's really been our focus, is building this kind of ecosystem where we can kind of plug and play all the different things that these companies need. And we can really hold them accountable because we are offering those services and we are actively involved in the team. We're not really investing for these 40% discounts and quickly flipping it. We're looking for this medium to long-term play where we can really be involved in the team and keeping kind of checks on that.
I think from our perspective, and that's why when we look at the founder, so we really like the founder that has been in this space for long enough, and if you haven't been through any cycle, if you haven't been through the up and down of the token price, and because it's very distracted for any pre-product and pre-traction company founder to look at the token price just going up and down. So that's why all the public market in the public sector, and then all the public companies, so they have a dedicated team for market cap management, and then for for IR as well. So I think it's very important as a founder, you have to be psychologically prepared for it, and so it's very hard just enforce anything to hold the founder accountable. So the founder has to be really perseverant and has to just be persistent.
I think there's two sides of this too. It's first of all, from an investor side of how do we make sure that the team is accountable, which I think is much more difficult to do in a token model than it is in an equity model. As an equity owner, you have actual rights. You have basically no rights as an investor in a token sale, and that's very difficult for us to deal with as far as managing downside risk. The other side is, from the perspective of the token project itself, or whatever your company, token project, whatever you want to call it, which is making sure that your investors are aligned with you long term. And again, I think that one of the smart things that was presented earlier on stage today was just the idea of lockups investing for your investors. That helps weed out the people that are just there to collect some discount or some favorable valuation, then flip out of it. Ultimately, a good investment partner is somebody that's there for you in the long term to help you build a company, a protocol, an application, whatever it is that you're doing, and not people that are going to abandon you in 6 months.
Joey, do you want to say anything?
I would say, I'm a bit more comfortable investing in tokens than I think Spencer is. I think part of the reason is I think there are still a lot of those sorts of, a lot of the protections you associate with a company are much more kind of sort of fiduciary duty sorts of things, or very rarely as a venture fund do you actually get down to the letter of an agreement and sue a company you invested in because they screwed you over. It's usually much more soft kind of reputational things. And so I think if you look at token sales, there are a lot of people in the space who say, well, they can just spend the money on whatever they want. I don't think that's actually true. And I think this will be challenged at some point, probably in court. So say you're a token project and you create a nonprofit in Switzerland, and then say you launch a VC fund and a hedge fund with the money you raise from people who are trying to pay you to build this protocol. In that scenario, I don't think you're fulfilling the fiduciary duty to your nonprofit that you kind of created. You weren't supposed to create a venture fund and a hedge fund. You're supposed to build this protocol. That was the kind of mission of it. And so I think a lot of these sorts of things will be challenged as well. And I think, maybe now it's kind of wild, wild west, but I think as time goes on, while token holders don't have rights like a shareholder does, they do still have the company building this or the nonprofit building this still does have the obligation to actually do their best efforts to actually build it and not just run away with your money. I think that would still be illegal and failing to fulfill their responsibilities as a director if they just took the money and bought say a Lamborghini, just like it would if they did the same thing for a company funded with your VC money.
Thank you. I want to touch on what Dovi said earlier. There's a lot of entrepreneurs here, developers are interested to see more. How do you guys pick your projects? So what is your deal flow looks like? What attracts you more, and how do you even value those projects or those tokens if you invest in them?
So I would say, one very interesting finding is, actually a lot of the blockchain founders, and they are not decentralization believer. And so this is very interesting that you might be thinking, so if you are building a blockchain product, so you must be very decentralized person, but actually a lot of founders are still very centralized mindset. And I think this is the biggest philosophical division that for the founder that I will invest, and then for the founder that I will not invest. And then secondly, I would say, so the founder has involved in this space for long enough, and that has been through cycles, and so they have a good community connection, because for any decentralization project, it's always about building the ecosystem, and then so you have to think about whether this project is a blockchain must project, and then whether it has to be decentralized, because if the experience is actually 10x better as a centralized experience, and so there's no need for decentralization, and the other thing I would say is. And being being a crypto founder, building a team. And so what makes a really good crypto project, there are 3 elements. The first one is, so there must be a crypto expert, and then also a distributed system expert. And then so the last one is you need to have a really good game theory designer. And so the 3 domains actually, previously, so they not usually collide. and then but like right now we have seen because of the ICO hype and then so the Bitcoin price insanity, like we have seen a lot more qualified founders and like really good talents like used to be from academia, say for instance. So I've known like early this year like a group of like Scott Schenker students who used to work on like networking protocol, and right now they're actually devoting themselves in like blockchain. So like which is a very like good opportunity, and then so like that's why when it comes to deal flow, and so we work with like Pantera a lot and like blockchain capital, Polychain, and then so other than that, so one of our unique deal flow is say for instance we invested in like Brent Cohen's like share network, and then so that is actually referral from them, so from Dan Bonet from Stanford, and so we invested in like DAG Lab and like QED, so QDIT, and then so that's actually from referral from Alessandra Chiasa here from from like Berkeley CS department. So I think one unique deal flow we have is that we have this very good access from the academia, and so they can help us to have like some advantage when it comes to deal sourcing.
Yeah, I'd say on the deal flow side, most of it is either inbound or introduced to us at some point. A lot of the times they're looking for technical advice on, say, building on Ethereum, or some sort of game theory problem they're trying to solve, or they just want to talk to us because we're well connected in the space. On the sorts of projects that we like to invest in, I think the kind of most interesting stuff, or the way I start, is I start with the tech, because with the space is so kind of popular and exuberant right now that you see lots of people who have really good backgrounds, and the team looks great, but their tech is just completely nonsensical, and it's because they're just jumping into the space and don't really know what they're doing. So I start with the tech because it's fastest for me to just go through the tech and see whether it makes sense. Basically, it's just looking for things that make sense. A lot of projects are doing things in this space where if you were to solve the problem, you'd win multiple Turing Awards in computer science. And unless you're one of the academia people that she is talking about, it's probably not going to happen. And so then after that, a lot of it's whether the token model makes sense at all. The sort of stuff that is exciting to me is where currently today you have a central intermediary who's sitting in the middle, extracting a lot of rent, charging a lot of fees without adding value proportional to the fees that they charge. And if you can cut them out by replacing them with kind of a more peer-to-peer cooperative model, those are the sorts of things that we like to participate in. And those typically kind of tend to need a token for kind of obscure technical reasons. If you look at like OmiSco or Ethereum, they need the token for pretty kind of obscure technical reasons. Whereas stuff where you can kind of tell that they've just slapped a token on top of it because they wanted to do an ICO, I think those won't be around 5 years from now. And so that's kind of how we're thinking about it at a high level.
Yeah, so it's like I think what we really pay attention to is like kind of three things: team, tech, and community. Like team was already mentioned before. Like a lot of these things can pivot, a lot of these things can kind of change, but you really need a strong team who has kind of a record of executing. That'll be kind of usually indicative of that they can execute in the future. You really don't have to be as actively involved in keeping them on track. Obviously, having a really solid team that has a basis in the space or like kind of an expertise in the vertical they're developing on is really great. The tech, like I mentioned before, is like extremely important. If you look at their GitHub, it's just not very great. If they don't have any blockchain expertise on the team, that can be really problematic. And also one of the biggest drivers is community. A lot of these teams get a lot of money, but they really can't get that kind of community buy-in. They can't get developers. They can't get people to use the platform. So really being able to kind of organically source that community is really important. As far as deal flow, we have really close ties with Berkeley. There's a huge community basis here. There's a lot of developers. Like I mentioned before, that community factor, having people who kind of contribute to these platforms and are able to actively develop on it and build it out is really valuable. So that's where a lot of the deal flow comes, is because we offer a lot of utility from these teams. We also have a real expertise in the privacy sector. One of the individuals from our team, Howard Wu, is one of the few people who kind of understands this zero knowledge proof kind of ZK snark space, and actively helping to research and develop it out. So a lot of these privacy-centric things will kind of come to us for our ties with academia as well as the expertise in that field.
Yeah, I agree with most everything that's been said here. I mean, listen, we're not completely changing the way that you deploy capital to early stage projects. I mean, overall, the features are very much the same. I mean, it's team, tech, problem, in the market that you're looking at, with probably the biggest shift just being that tech is probably much more important than it has been in other areas.
Yeah, maybe you can say only one thing that you would never invest in today. Like the tower project that just like doesn't make sense at all. without naming it? I mean, I know I talked to Joey before, and he said like every year, like rent seeking, for example, you're trying to stay away.
Tokenized sand. I think we saw a project for tokenized sand, right?
I was gonna say, like, I see a lot of projects that are just kind of mimicking Ethereum. You know, they're like something that kind of is replicating something that's already existing, especially Ethereum. So that's one of the biggest things I look for. You know, is it trying to just do something in not a better way than something that already exists?
I'll go with the rent-seeking one. So basically the idea is if you have someone so the whole idea of this space is to disintermediate middlemen and make things have lower cost because you're making things more efficient. And so a lot of tokens that come to us, I'd say like 99% of them, actually insert themselves in the middle, decide they're going to charge a bunch of fees, and there's no barrier, there's no moat, there's no reason someone wouldn't just remove the fees and make a free version. And so like in a nutshell, when you have a token, the sort of thing that you want people to be, well, people are willing to pay for security of the network. So they're willing to pay for the security that the network is secure, like in say Bitcoin or Ethereum. They're not willing to pay, you know, the founder 5% every transaction or something like that, which is a lot of what we see.
Yeah, and I remember, so I've seen one project, so it's a friend of mine, and so he was working on, so he was working on a pizza delivery company, and one day, so he basically just pinged me saying, so I'm thinking about tokenize my business, and I was like, how you can tokenize a pizza delivery company, and I think like one thing I figured out is so because we have seen all these services and like products like both like online and like offline. Like if your primary business is like mostly offline, so it's actually very hard to tokenize because you need this like digital representation of your business and your current workflow like online first, and then you can tokenize it. So I think for like the Uber, like the Airbnb, and like all this probably we can. For now, stay away from it, and like before, like the infrastructure is really ready for it.
Yeah, I think that leads me also to the next question, more about how the industry and the trends. You guys see the industry from a helicopter view. 2017 was very obviously the ICO rush, a lot of very interesting projects, a lot of money involved, but what do you think are the 2018 trends and where this industry is going this year?
I think launching an ICO is going to be a lot harder. I think that people are becoming a lot more critical. I mean, we've seen, you know, either from the helicopter view or from the first row seat, the market cool off a lot, and I think that's probably healthy. I mean, as with anything, I think we saw kind of a natural Gartner hype cycle here. So, you know, the market got way ahead of itself. You know, is there something at the core that's really, really interesting here and is going to be part of a long-term megatrend? Yeah, I think so, absolutely, and we plan to continue investing in it. But definitely in the short term, things got ahead of itself, and a lot of projects don't make sense. So I think people are getting smarter about how to think about projects that need a token and ones that don't, and what makes sense as far as a sale and valuation.
Yeah, I definitely kind of piggyback on that. I think we're going to see these kind of like timelines be elongated. I think a lot of people are rushing a lot of these things to kind of get on this hype, to kind of cash out on it. So I think we're going to see, you know, we're already seeing in a lot of our deal flow these like equity stakes or these longer lock-ins or these different kind of structures where it really makes sense for individuals to kind of get involved early, where they can actually be a value add. It's not, you know, you're getting into a pre-sale and you're immediately flipping your tokens or have that liquidity in a month. So I think we're going to see kind of like more rational, you know, like pre-sales and like also like equity stakes. I also think it's really interesting, you know, being at DevCon and a few other places, privacy I think is really going to take front row. There was kind of like ZK Snart like breakout rooms, and you know, people were asking the developers how many of you plan on incorporating privacy, and about half the room raised their hands. So that's really promising. You kind of see right now it's all about scalability. Scalability is interesting. It's sexy right now. It's really kind of this offense. But you know, with offense, you kind of need that duality of defense. And I really think that privacy is something that is undervalued and underrepresented currently. And I think 2018, it's really going to take front row.
Really good point. Yeah.
I think in 2018 we'll start to see some, you know, popular dApps on Ethereum go live. Right now, people are just trading tokens, and that's basically it on Ethereum. I think to be able to do more interesting stuff in 2018. And then also, I think we'll start to see some of the first stablecoins as well, which I'm pretty excited about, because if you're entering into, you know, some sort of financial contract on Ethereum, you don't want to lose money due to China announcing some news about Ether and losing 30% overnight. You want something that's, you know, relatively stable. So I think some of those projects will go live. And then, yeah, as he said, scalability is pretty important. I think in 2018, we'll start seeing kind of the first wave of low-hanging fruit practical solutions to scaling Ethereum. So Ethereum's developer community is much less kind of abrasive than Bitcoin's, and they're willing to make changes to improve it. And so I think the kind of first thing that will happen is there'll be parallelized transaction processing. So you'll be able to process transactions in parallel on Ethereum. So that's like an 8x performance increase. If you imagine most computers today have 4 cores, each core has 2 threads, it's 8x. And then beyond that, it starts getting harder. You can make the Ethereum virtual machine more efficient. It was originally just kind of slapped together as a proof of concept. Let's see if this thing works at all. Now that we know it works, it's time to make sure it's actually efficient, and it's not. There's stuff that on Ethereum takes, milliseconds. It takes microseconds on my iPhone, as an example of a simple computation. And then after that, scalability gets a lot harder, and it becomes a multi-year process of doing things like sharding and plasma. But I'm confident we'll get there.
I think for the 2018, so right now we have seen actually like a new model of like fundraising. So like essentially it's not a new model, but previously we have like ICO, and now we have this IEO. That's the initial exchange offering. So I think the whole model will actually rolling back more into the venture model, and we have seen many of the many of the solid projects. So they basically just like raise that pre-sale and just like skip completely the crowd sale and just list on exchange 100%. And so that's something that we consider as IEO, like initial exchange offering. And so that will become more and more often. And and I think the institution will play a more important role here when it comes to fundraising. And because when more veteran founder gets into the space and they have like previous access, so first of all that they're a veteran founder, they are familiar how to raise fund, and they have the existing access to VC or the other institutions. So I think the model will definitely rolling back more to the venture model. And I want to talk about China specifically, actually. And I think there's a misunderstanding about okay, China banned everything, so there's it's a complete dead space. Actually, from what we have experienced, and because we directly involved in the whole PBOC discussion, and the PBOC discussion, and then the China SEC visit, etc. And so the whole thing actually becoming even more vibrant than before. And so there are actually 2 reasons for that. First of all, the China ban is actually the best publicity ever for the average investor in China, because they actually don't trust government, but they have no choice previously. And then now, because of the rebound of the Bitcoin price, actually demonstrate the value of decentralization. This is the first time ever in the history, so they realize, oh, there's something that the government cannot manipulate, and this gets them really excited. And so that's the first reason. And then so the second reason is, and if you actually monitor all the transaction volume, even though the China government they banned all the centralized exchanges, and pretty much the second day everything gravitated towards fastly to over-the-counter transaction. And then over-the-counter transaction, there's no control over. And as long as if you're as long as you have Alipay and then WeChat Pay, because we all know that the digital payment method is very advanced right now in China. And as long as you have those 2 payment methods, and Alipay has 400 million users, WeChat Pay has 600 million users, which means immediately over 500 million of user, average consumer have direct access to cryptocurrency. And so that's why I think it's actually even more vibrant than before. And because we have, actually we looked at one stats, and so before the China ban, there were about 2 million cryptocurrency holder in mainland China, which is actually it's very small. And then after the ban, so the overall number of crypto holder, crypto holder actually grow quickly, even than before. And so that's why I see in 2018, when it comes to global when it comes to global economic, and China will still play a key role in mining, in like investing, in like entrepreneur. And so if you are a blockchain founder or like crypto founder, so you really need to have this like flatware mindset. And I think this is the sector probably is the first time in history that Silicon Valley has no unfair advantage in accessing of talents and capital. So you really have to be global from like day one.
Thank you. I want to touch on one point that Joy said about stablecoins. So once stablecoin is introduced, what is the purpose of utility tokens?
Before I answer that question really quickly, because stablecoins are a really interesting issue, and I was hoping to follow on that as well. First of all, I'd say that I really hope stablecoins succeed. I think they'd be a boon for the entire industry. There are large applications that would be really incredible that might need stablecoins in order for them to work. That said, there's a lot of things that I hope come into the world that don't. I've wanted flying cars for a really long time, and we haven't gotten those either. So, it's okay in venture to be both skeptical of something and then even to hope that it succeeds and maybe even potentially invest in it. When I think about stablecoins overall, it feels like a technical solution to a problem that is fundamentally economic. At the core of what I see stablecoins is you tell the market what the price is instead of the market telling you what the price is. That goes against everything I've ever learned in economics and seen play out in markets. But again, I really hope they succeed. And even with a very low probability of success, a stablecoin could be so large that an investment could still make sense. Even at a 1% or 0.01% probability, the market is potentially huge. So it could still make sense.
I think the probability is much higher, and I'll give a reason why. So there's two types of stablecoins. There's some types where the money's not really backed by anything, and it's very similar to kind of the way a central bank works. And you increase the supply when the price goes up. When the price goes down, you incentivize people to decrease the supply. Some projects do this by issuing bonds. It's not that unfamiliar. The only difference is, of course, there's no government backing it. Whether that will work or not, I don't know. The other type of stablecoin, though, is backed by collateral. And in the short to midterm, so like in the next 5 years, it has a decent chance of not working. And the reason is the collateral that you would back it with, other cryptocurrency, is super volatile. However, if you fast forward, say, 10, 15 years and think in the future where traditional assets will be tokenized, things like stocks, bonds, commodities, et cetera, you could very easily envision creating, a sort of kind of like all-weather portfolio like Ray Dalio has. You could vol target it to have like 4% annualized vol. And then if you have a collateral-backed stablecoin, say it's backed with 5-to-1 collateral and your annualized vol is 4%, that has a very, very slim chance of failing. Like the peso probably has a higher chance of failing than that stablecoin would. And so I'm confident that those will work. I think it may be a long time though. And so I do agree with that. And as far as the implications of them, why do you need utility tokens? That's a great question. So a lot of them, there's kind of a few classes of utility tokens. There's ones that aren't needed at all. They're not needed today. They won't be needed in the world of stablecoins either. There's ones in the middle, which are, payment tokens, which are used to do payments on these networks. My thesis on those is that they might be able to succeed if the application is popular enough and has a large enough network effect. But when stablecoins come out, it's much harder to make a strong argument that those will have really lasting value. And then the kind of other type is things where the token's really needed, and if you remove it, the system just doesn't work. So an example of this is a network that requires the ability to split into two, or requires forking. If you use a stablecoin instead, well, you can't just double the monetary supply when you have a fork, so that obviously won't work. And there are some computer science consensus mechanisms that require the ability for a network to split into two universes in the event of a disagreement to work. And so those are kind of a very obscure technical case where tokens are needed.
Yeah, so I think like stablecoins are really interesting, right? Because it's all like relative stable. It's stable relative to what? I think there's going to be a lot of iterations on this. I do think that China is kind of taking the lead on this from the few entities that we've been working with. Digitizing kind of the RMB or digitizing these things is really something that's going to be top down. Once you have like that much liquidity, that kind of like big of a float, you have this relative stability kind of relative to your currency that you're using. I think it's kind of interesting, that question, like once you have stable coins, what is the function of utility coins? Even that kind of relation is problematic because it shows you how much people relate cryptocurrency to value. When if you have this utility token, it should be kind of like implicit that you're using that token for the utility provided, not necessarily as like a store of value or something like that. I would hope that utility token is kind of utility centric rather than value.
So I think like for like stablecoin, and so there will be like multiple versions, and it can be a very interesting competition like within the stablecoin ecosystem. And so there might be like coins like Basecoin, and so probably the other version of like Basecoin, and like similar with some more like improvement of the economic like design, and like so the other type of like the stablecoin is because like all the governments right now they're actually competing for the fiat tether, right? And like Japanese government, Chinese government, like Russia, Korea, etc. So I think there would be the competition both from the private sector. So private sector, so that's from like startup team, and then the public sector, so that's the government-backed like collateral base, and so tether to specific fiat. And I think can be a very interesting game theory and competition with each of the players out there. And when it comes to the utility token value and because if you think about how we value something right now, and it's actually based on the adoption and the utilization of the specific product or service, and so that is essentially how we should value like utility token, but right now it's really hard like before anything that has attraction or like a good community around it. So I think like we will figure out that how we can value the utility token like once we have like a few stable tokens that can be the best options.
Yeah, I agree. One last thing from the trends is what for the developers and entrepreneurs here who are thinking of starting a new company now, what kind of initiatives or type of projects are missing in the industry that people should start working now so within the next year or two they can be very relevant?
Yeah, I mean, I really can't kind of emphasize enough. I think we really focus on that privacy kind of factor. I think we're kind of at this interesting kind of intersection between like government, between academia, and then also between like corporations. And we kind of really see that with scalability, we're doing these proof of concepts, we're trying to build these things, but they just kind of stay proof of concepts, even if you can kind of meet those scalability requirements, because they want to keep a lot of these things private, because of these other kind of requirements, and because of the legality around it. So I would really say that I think this is going to be a huge push. I think it's going to be something that you're going to have to implement into a lot of these platforms to kind of take it from proof of concept all the way to where you're actually like using it in production.
I think one thing currently missing in the space is custodian. So we haven't seen any good custodian project at all. So that's something I find missing right now. So like the other thing is when it comes to our investment thesis, because we have been primarily focused on four things like ever since like 4 or 5 years ago. So that's programmability, scalability, anonymity, and like eco-friendly. And so those are the four space that we are thinking that like we can constantly like making investments because those are the infrastructure. And when it comes to platform or like application layer, so we identify CDN, VPN, like prediction market, and decentralized exchange, and like those are the good space to invest. I think that's it. Yeah.
I would agree. I mean, I think that privacy is definitely one of the big ones. I'm glad that you emphasized that. I think it's always been, not to downplay how important scalability is. It's obviously really important and really, really challenging. But privacy is a little bit underappreciated relative to scalability. People don't want to have all of their contracts exposed to the whole world. It's just really not a desirable outcome. So privacy will be interesting. Decentralized exchanges will be interesting. And we're investing into both those things, as well as custody.
So maybe we'll jump to the next kind of topic is more advice to teams. I'll just make it a free form. You each one can say like the most important advice that you can give to teams today to kind of get up to speed and successful, hopefully.
I mean, some of the stuff that we covered earlier I think makes a lot of sense. So, I mean, helping make sure that you align yourself with long-term strategic partners that can help add value and help you build out, whether it's a company, it's an application, it's a protocol, it's a token. You need people that can help you do that. Doing things like lockups help from an investor side. And then just in general, I mean, doing things in stages is probably reasonable. I mean, that's the way that people have built businesses and companies over a very long period of time, and it's a relatively proven model. And so, going out and expecting to raise $200 million and build the perfect product in the first iteration might not be realistic. And so, taking kind of a measured approach is probably appropriate.
Yeah, I mean, I think that like the difference between kind of being rushed and just being driven. I see a lot of teams that are willing to put in tons and tons of hours to get these things kind of implemented, but I also see a lot of teams that are kind of rushing. They really feel under the gun. They feel like, this is a very short window. They have to raise a ton of money and figure it out later. I think this legality issue that's coming up, that we're going to probably hear about, we've been hearing about all day, we've been hearing about currently, is something that's kind of a huge factor. Do this right. That's what we're generally trying to support in the space, is to be responsible with the way that you raise, because every time something fails, every time somebody raises an obscene amount of money and doesn't really deliver, that really generally hurts the ecosystem. So that's what we're really kind of hoping, that people stop being rushed and just kind of do things correctly the right way.
I'd say, so before you decide what you want to do, like figure out like what sort of project or product you're building, and only then after that decide whether it makes sense to do a token sale or not. Don't go into stuff and say, oh, I'm going to do an ICO. Because that's how you see most of the projects in the space are bad, and that's one of the primary reasons. If you design like the thing you want to build first, and it happens that it needs a token to work, that's great. You should hit any of us up. But if you just like walk up and say, I want to do an ICO, and it's in this sector, and I feel like doing an ICO, like please don't. And then I think the other thing is, once you've started a project, some advice I have, just things that are like super annoying in the space that I see that you should avoid. One, don't let anyone advise you who asks to advise you most of the time. Two, don't pay people to be listed on apps or sites or anything like that. If a wallet says they want 75 grand for you to be listed on it, tell them to screw off. Three, if you're doing a token sale, you really should not 99% of the time be using one of these kind of token advisory, token services firms. Here's the reason. If you're building something that actually needs a token, then doing the token sale, writing the smart contract to do an ERC20 token, that's going to be the easiest thing you'll do for a long time. Everything else is 1,000x harder than that. So if you can't do that part on your own, then there's no reason that you should even be in the business of building one of these things. And the reason these kind of advisory services are so dang annoying to me is they take around 10 to 15% of the funds that you raise, and they take 10 to 15% of your entire token supply. And they don't add value proportional to that. They're worse rent seekers than even the worst bank you could possibly think of, like 10x worse or 100x worse. So avoid that.
10%, really?
Yeah.
Yep.
Yeah, so I think my advice would be, so first of all, don't do ICO just for the sake of like raising money, and because so the token should naturally integrate it with your so your economic design, your like the workflow, and so the utilization and like functionality. So like it should be naturally blend into what you're building. So it shouldn't be just for the sake of like raising money. And so purely for the sake of like raising money is a really bad idea. And second, just as Joey said, like those advisory firm, and they can do everything for you, like even writing the white paper for you. And so if you're an entrepreneur like that, and then so like what is the value of you being an entrepreneur and like being the founder of the company and like the project, right? So I think the other advice I would have is being very adaptive, because the whole environment evolving very fast. So we are investor of Brave, so basic attention token, and so we invested in last year, and so somehow the whole concept of like ICO, just like so, because like crowdsource has been around for a while, so it has been around for like 3-4 years, and so because so this year it's just like people just like repackaging the same idea of like crowdsource into ICO, and then which is a very easily understandable concept, and then just like get a hit. And so when like Brave like did the ICO early this year, and then so they have made some mistakes, like say for instance, so they don't have like a specific cap for the individual like wallet address, and then so right now it's very, very concentrated, and so later on like 0x has like a better model so that each individual investor can only invest like up to like a few thousand. And so like the whole mechanism actually evolving very fast. And then so talking about like the contrast, like say for instance SAFT, and we have seen probably 20 different mutations of SAFT. So like 20 different versions of like SAF or like the token sale agreement, and so like things actually evolving very fast, and you have to be very, very adaptive. And like the other thing is like be really patient. Like Definity, we invested in 2014, like early 2014. Like back then it was not Definity, so back then it was just Quantify, and so they actually pivoted probably 5-6 different times, and now become so now it's Definity. And so you have to be very patient, and like if you're really thinking that you want to dedicate it in like blockchain space, and it's still very nascent, and we are probably at the first like 3 minutes of the whole like universe of like blockchain. So be very, very patient, and then be like dedicated. And so I think eventually like you will actually see like all your hard work like really paying off, and not just for like quick cash.
Thank you. We have time for about 2 to 3 questions.
You mentioned custodian in one of the things that you said were lacking today. I didn't quite get it in the context of a decentralized blockchain environment. Can you please elaborate on what you meant by custodian?
So like custodian, like say for instance, like how we can ensure the security of a specific proceed, and so right now no one has a good solution, and like basically I think like if we are all like token or like alternative like coin holders, so we basically like do it by our own, right? And so there's no such a service or like project out there, and so can provide good custodian service. And then like custodian service, and so this is very similar to insurance, but like so it's like definitely more than insurance, and so it can be a combination of like technical challenge plus like insurance, like plus like regulatory question as well. So it's a package of a whole that how you can secure the transaction from like one entity to another, and so that's something that I'm currently seeing there. I think there are like each individual like service providers. Say for instance, you can buy like Nano Ledger for like cold storage, but like it's like very, very silo. So we have to piece everything together by ourselves. And it's, I think especially when more and more institutions and like hedge funds and come into the space, and like this can be critical.
Some sort of a decentralized private key management solution itself. Because today the private keys themselves are to be managed by each end user or the exchanges.
So for decentralized like key management, it's just one element, and you also have to think about like auditing problem.
Got it.
And so like that's why I think it's very, very complex. Yeah.
Got it. Thank you.
The VC model itself is like a centralized cartel, right? I mean, there are like centralized mining entities. So how are you guys like restructuring yourself? Like, I mean, it's a decentralized world. Capital is being decentralized, become a commodity. VC's role probably would diminish, but how would you structure yourself? I mean, I do think there's a role to play because you get decades of experiences. To your earlier question, we don't have flying cars. I think it's because of VCs, because they're not interested in building long-term projects that involves a lot of capital, capex, that yield some cutting-edge project. That's why the government is involved in some of those large-size projects. So where do you guys see that once the capital becomes commodity and everyone else is able to raise it, where's the role of venture funds or hedge funds?
You're right, absolutely. The model of venture capital, I do think, is changing. At the start of the year, when we looked out and realized that some of the entrepreneurs in the space were completely bypassing venture capital altogether, I mean, even prior to that, we had noticed that a lot of the companies in the space didn't really want to talk to the people on Sand Hill Road. Fortunately, I think a lot of the industry-specific investors had a little bit of an edge there just because they could talk the same language. But, starting at the, kind of beginning of the year, started to notice that some of them were just bypassing all of the venture firms altogether. One of the things that we did to try and address that was to raise a fund via an ICO, and so allow anybody to improve access. I mean, normally to have access to a venture firm, you have to be kind of an elite institutional investor. In our case, we're able to accept capital from 750 investors in 80 different countries around the world, and able to provide kind of an improved liquidity profile for it as well. So it's definitely changing, I agree.
Anyone else?
I'd say commodities, or money's been a commodity for a while, like ever since the kind of low interest rate era. And I think something similar will happen to kind of VCs, what happened to VCs in the past with AngelList. So if you look at AngelList, tons of syndicates started popping up. And as an entrepreneur, if you're raising a seed round or even a Series A sometimes, why would you go to a B, C, or D tier VC firm to raise it? You would instead raise it from angels on AngelList. The good A-level firms, they're always going to be around because they're actually adding value and helping the companies and projects along, helping them solve real problems that they face. But kind of if you're not in that level, then yeah, I think you will be disrupted.
We'll take one more question.
How is the enterprise blockchain, how's it impacting your portfolios? And what is it, 2017, 18, and 19?
So what is
The enterprise projects.
Also the enterprise.
Yeah, I mean, so overall, with at least I'll speak from my perspective at Blockchain Capital, we're trying to provide our LPs with diversified exposure to the blockchain industry. So that does include enterprise blockchain solutions. We have enough humility to recognize that we don't know for sure where all of these technologies are going to go and where they're going to be applied. And we want to make sure that we pick what we believe are winners in every major category. And enterprise blockchain has definitely been one of those. It's not an area where I think I have the strongest level of conviction, but it's definitely something that we have invested in and are not particularly exploring right now, but would continue to invest in if the opportunity was right.
Anybody else?
I guess actually to add on that as well, probably one of the things the industry could have done better early on was defining what is a blockchain, right? And so instead we kind of have the spectrum from a database to something that is actually like decentralized, like Bitcoin or Ethereum. And I think in some cases, some of the enterprise blockchain projects might just be databases kind of repurposed and repackaged. On the one hand, that's a little bit unnerving, but on the other hand, but the flip side of that is that if it takes kind of a shiny new wrapper to help people upgrade their database and receive significant new efficiencies, then that's okay as well.
Yeah, just kind of add on to that. So it's like doing projects for some of these large enterprises. I'm not going to name any names. They're definitely like not the most interesting kind of solutions. Like a lot of them will want these kind of proof of concepts, want to kind of see what's going on. Like you mentioned before, like really knowing the definition of a blockchain. You'll build this entire proof of concept, and they'll say, all right, if one of our engineers makes a mistake, how do we roll this back? And it's just like really frustrating after kind of doing that. If you spent months and months and months building this out, and you think they understand. So I would say that like the things that we've seen so far that are coming from these large corporations, they're kind of a little slower to adapt. They're really trying to shoehorn this technology into existing verticals and use cases, and a lot of times that really isn't the best kind of like way of doing this. So I think some of these new, more agile companies are really doing more interesting things. That being said, I think to really bring this mainstream, you're going to have enterprise adoption. They're really going to kind of like flesh this out. But I haven't necessarily seen anything super interesting, but I definitely agree if there's something pops up, we're definitely interested.
Yeah, we don't have any more time, but thank you to our panel.
Thank you.